Welcome to another VC Wisdom Pod. We have Idriss Al Rifai with us today. Idriss is co-founder and CEO, had him on the pod various times, was the founder of Fetchr as well, chief strategy officer at Glovo, started a bunch of companies, was a professional basketballer and also a special force at some point of his career. So very interesting guy. So Idriss, welcome again to the podcast. Tell us a bit more about yourself and what you've been up to as of late.
Yeah, thanks, Charles. Thanks for having me again. It's been good. Yeah, I think like the past few months have been quite intense. So trying to like I was saying, like I think for me the going from 0 to 100 people, like 10 to 100 people, is the most interesting part of a startup. When you start building department processes and you start getting into the big pond. So yeah, interesting time for sure.
And the 6X, explain how that happened specifically.
The 6 what?
6X, you said that you were 6Xing.
6Xing, yeah.
Growth. Yeah,
we're supposed to do 6X. We're supposed to do 6X this year. We're pretty much at 4X right now, so it's not going too bad. But obviously there is a base effect, so the last 2X are the biggest. So no, it's good. It's interesting, but we're in markets where things are happening. We're just talking about this right now, like between the UAE and Saudi. I think there is such a huge momentum on building, like not only tech startups but especially fintech, that are gathering like right now the lion's share of financing in this part of the world. So yeah, it's interesting to be part of this ecosystem right now.
And how did that happen? Because most companies actually go minus 2X, and while you go like 4X. So was it funding? Was it strategy? Was it GTM? How did it happen?
Look, for like the way I think, so like we're doing revenue-based financing, right? RBF in a part of the world where SMEs represent 60% of GDP, 80% of job creations, and only less than 10% of bank lending. So for everyone listening, like think about the Western ecosystems without bank. That's basically the best way to put it. Like, so they do, like the companies that we're interacting with, they do have bank accounts, but that's pretty much the only relationship that they have with their own bank. They don't have access to any kind of financial products. Anything south of like $30 million top line is very up for grabs. So obviously there is some pros and cons. I'm not saying it's super easy to start a company here and to grow a company here. But some of the problems that scale-ups have in the Western world, we don't have that. But anyway, again, for some segments, not for all. But in a way, my business is like, for me, the way I think about growth is about having a triangle in place. So one is to have the right debt in place, because obviously we're raising warehouse debt, and having the right conditions, the right amounts, the right terms is super critical. And to have it at exactly the right time so that you can deploy is quite an art. So that's one. Two is obviously equity. You need to have equity for you to be able to get the debt. So having the equity too early is a problem, or the debt too late is a problem. So you need to make sure that you sync both of them in your expansion strategy. And then three is a CAC over LTV, because obviously you need to have your CAC in check, you need to have your LTV in check. And if you have both of them in check, then you have a good ratio on CAC over LTV. And my business is that it feels like this is the three sides of the triangle. And if I get that right, then growth is here. So the reason why we grew a lot this year was because our debt facility just increased quite a lot, and we raised some equity. So for the first time, we're not constrained on any of the three pillars of the triangle, because the last one, CAC over LTV, is really good. So that's why we're just like growing and still trying to keep NPL, non-performing loan, below 1%, which is what we're doing. So yeah, right now is the exciting part. Like you have all the ingredients, and you can actually build what you're supposed to be building. So yeah, this is exciting.
And what does a day in your CEO looks like in terms of that triangle? Do you always invest time in these three things, or you have like one day for each? Like how do you go with that?
Yeah, no, I think so. There is obviously, so it's not a per day thing. It's more per sequence, right? Almost like per quarter. Obviously, when you're on fundraising, guess what? One of the pillars is going to be much bigger, the pillar of fundraising. But if you look at equity and debt, like you need to make sure that you nurture this relationship, including in downtime. So I have my hot list of like 10, 15, 10, 12 maybe investors that I want to work with and seems to be want to work with us. So like we're having like discussions and so on. So it still takes time. That's what I mean, right? Including in downtime. You always need to nurture the relationship with the investors when you don't need it. You don't talk to investors for the first time when you need it. That's one of the things that I've learned. So I would say it's pretty balanced throughout the year, but definitely imbalance within 1 week, right? Within 1 week, you can have a full day where you have like 5-6 meetings that are purely about either CAC or LTV. So that takes a lot more, because basically it's customer retention, customer acquisition. There is the whole company is about this, right? So it does not need to be 1/3 each, right? So you're spending about half your time on this, and then 10% and 10%. I mean, along those lines, right? Because obviously there is also some other thing outside the triangle. But yes, that's basically in a nutshell what you're trying to do on a weekly basis.
The customer acquisition part, like who do you target precisely? Who's your ICP, and what are your favorite channels to reach them right now?
Yeah, so it's funny because I was at Glovo. We're spending like north of $15 million per month in acquisition. We're massive. We're relying a lot on obviously it's on retention, but a lot on acquisitions because we need to prove like growth of top line and bottom line. So I was very like I was not worried, but like I wanted to find a way where growth, especially so where my CAC was a lot more in check. So we tried to go through a pure B2B2B strategy where my CAC is close to zero actually. Which is great. The reason why we're doing this is because, again, in these markets, you have some of the things that are a lot more difficult to do than in the West, but some of it is easier, or I would say at least different. So a lot of there is a huge appetite for SME lending. A lot of companies Fintech especially, wants to introduce some kind of SME lending. So the way it works is that they come to us and they want to see whether we can provide any kind of lending to their portfolio of companies, their portfolio of services, either at an add-on services at arm's length transactions, or whether we can do partnerships where even we finance them. They just touch their bank account and then we go to the client. So there's multiple ways to skin the cat and to build up partnerships. But yeah, so this B2B2B partnerships is going super well, and I think it's a lot of. So for example, I don't have a marketing team. I have a sales team of 1 person across 3 markets. So just to give you an idea, right? So it's just a lot of channel management, a lot more than customer acquisition.
And who are these businesses referring you clients specifically? Tell me a bit more about that B2B2B. I don't often talk about that on the pod.
So from a partner perspective, we're dealing with any kind of clients, right? Any kind of partners. That can be, just to give you an idea, that could be a payment gateway that want to introduce lending. That could be a POS player that want to introduce, POS financing through us. It could be an expense management system that want to, that has relationship with a lot of SMEs then we could be working with. It could be an open banking platform, where we could extract some of the value through their own information, but also finance them. So there is just a different way. There could be e-commerce companies, for example, e-commerce platforms, food delivery apps. We're working with one of them, where they refer restaurants to us, and then we finance the restaurants, and we collect directly from the app, from the platform itself. So there is multiple ways to get clients, and that's why if you look at the way we actually expose to 21 different sectors. So we expose to the whole economy, right? And this is really what we want to do, because we don't want to be only financing, SaaS companies and tech companies. There is a huge layer of SMEs financing that is just missing in this part of the world, and we want to make sure that we're tackling this and not only 1 or 2 segments. From a pure customer standpoint, I would say almost it does not matter, because we're industry agnostic, stage agnostic. So it could be a meat manufacturer, it could be a solar company, it could be a services company that does cleaning services, or a lawyer, a law firm. We go all over the place. As long as the fundamentals of the business are here, that we manage to assess through AI, then we're happy to move forward.
And your top markets, UAE, I would guess Saudi as well. Do you do Singapore?
We're present in two markets right now, UAE and South Africa. And we're starting Saudi now. So yes, Saudi is going to become most likely our biggest market within the next 12 months.
Why do you think so?
Saudi is the biggest market in the GCC. That's one. If you look at the number of SMEs, you have a much bigger number of SMEs in Saudi versus the other countries. And then two, you have a super fast, a very strong tailwind in Saudi, right? I think you probably know that, but there is the addition of two or three elements that go hands in hands. Is that one, you have a very strong strategic vision, which is called Saudi 2030, and now the extensions of it, which is basically how to build the economy and diversify away from oil. So that's one. Two, you obviously have some of the strong fundamentals. If you look at the population of Saudi is 5 to 6 times bigger than that of the UAE. So obviously, in and of itself, there is an element here. And then three, you have also the base effect, right? A lot of these building blocks that you have in the UAE, because the UAE has taken off a bit earlier, are not present here. So all the issues with competitions, CAC, retention, all these issues that you tend to have more in the UAE, you have a lot less in Saudi, right? So yeah, for all these reasons, I believe that Saudi is the expansion is gonna be a lot faster than that of the UAE.
And massive cash reserves, right? Like, do you think that other countries can do the same, or do they absolutely need like gigantic piles of cash?
It's a good question. I think to be able to go at that velocity of Saudi is, you need to have, you can see, right? Like if you look at, like PIF, the public investment funds, right? A lot of the money that is coming to PIF is coming from, like Saudi Aramco and so on, and all of the proceeds that Saudi Aramco makes, right? So we're talking about hundreds of billions, So to be very honest, I'm not a specialist, but I think it would be very tough to replicate that kind of momentum and that kind of base as well, right? We're in an economy that was not diversified at all, like 10 years ago, and now that is changing a lot. So from all these reasons, both from a base effect perspective, but also from a velocity perspective, and the way the economy is not directed, but somehow spearheaded by like some of these like visions, I think it's unique, right? That's why I think being in Saudi right now is a unique opportunity for a lot of businesses.
Right. And you mentioned that you increase your loan capacity. How does one do that? You go to other banks. How do you actually prove them that you're credit worthy, for example?
Yeah, so like it's bank and financial institutions, right? So we go to like hedge funds, for example. The one that is financing it right now is a hedge fund from New York. So it depends. You have different pockets of money that are just interested of risk-adjusted return. So you need to do two things, right? You need to provide good returns and risk-adjusted. So therefore, you need to make sure that the risk is in check. So they look at track record and at your loan book and how many cycles have you had. We've been like 14, 15 cycles right now. So we kind of know where we're going, and we have like the fact that we have a non-performing loan that is below 1% is usually shocking to them. So right through the due diligence, they try to see how we do this, which is a combination of multiple things. But yes, so basically like the toughest part in my business is how to get some kind of financing at the early stage, because nobody believes that your solution is good. And therefore you have to use your own equity. And if you use your own equity, your loan book is going to be obviously very low, and therefore your revenue is going to be very low, and therefore your burn is going to be quite high, right? So you're a little bit on exactly what you don't want to be, because you have a lot of like tech, costs, because you need to build that solution. But technically you're not only small, but you cannot grow, literally, because you don't have money in the bank. So that's why it's a bit difficult to ignite and grow to some level. But once you're at the level that we're in, we can see like both from an advance rates perspective, but also from a facility size, it's a completely different board games. We're talking like hundreds of millions right now. So, which was not the case, like a year and a half ago.
Interesting. And Flow is only 4 years old. So how did you actually get these loans when you started? I guess you raised VC capital, and that's like what you would invest. And yeah, you went through all these cycles. But the other question there is how could you prove yourself so fast? Could you prove the returns? Normally, if you loan money to a business, they might not return it in like 5 years. So how did you actually prove the returns?
Yeah, it's a good question. So like, it's exactly one of the conundrums that we had to face, right? What kind of products? We know that 12 months and beyond. So forget 4 years, because obviously it's an horizon that we cannot even comprehend or serve. But we know that the markets at about 12 to 18 months is extremely high. We cannot do this for exactly the reason that you're mentioning, because you need to have cycles. You need to prove that you not only that your underwriting system is good, so that make sure that you don't make mistakes on how you underwrite, but also that your collection is good, and a few other things, right? So you need to have multiple cycles. So for that reason, mainly, we're actually focusing on short-term working capital, right? So our average is like 4 months, 4 to 5 months. So it's very short-term working capital type of facility, typically anywhere between $50K to $200K. And so that the money rotates quite a few times during the year. And that allows us to actually be able to talk to some of the bigger players so that we can get a bigger facility. And I think horizon 12 months, 24 months, we're probably going to go with like longer loans, 6 months, 8 months, 9 months, maybe 12 months even. And I think we're going to stop here because we need to have another check here, making sure, because the way you assess a company over a 3 months period, a 4 months period is very different than if you do it on 12 months, because obviously the risk is not the same and the time frame is not the same.
And normally a company that will return a loan on time and bring profits to you, that company will go to a big popular bank, right? So how do you get them first before they actually get to that bank? Or is it complementary? They do get the big bank, but they also get your loan, for example.
Yeah, we have both. I would say, if I had to guess, probably your first scenario would probably be more prevalent, right? So basically, like a lot of the companies graduate from us and then go to banks that are slightly cheaper, but not massively cheaper, probably about 10%. So you don't have a massive differences between the two. Is just that the size of the facilities will be bigger with the largest bank, and they just need, again, like the way it works with SMEs is that if this is your first loan and you're not big enough, banks will not give it to you, will not give you any loans. So therefore, being able to get a debt facility from an alternative financial institutions like ours, and having repaid, build some kind of credibility for you to be able to get to the big bank. So I would say that probably around 70% of the businesses we're financing do not have another facility with another bank. About 30% of them do have. So which means that even companies that have access to bank financing want to deal with somebody like us for mainly 2 reasons. Yes, we are slightly more expensive, but we're also a lot faster. We can give a decision like in 24, 48 hours, especially if it's a repeat. If it's a repeat, it's literally like it could be a matter of hours. So it's very fast. And 2, you don't put it's off balance sheet, right? So obviously it's something that could be also very interesting for some of these companies.
Right. And on your website says that you can loan up to 20 million, but I guess the average loan is what, like 20K? Like what's the average size of loan?
About $100K. That's the average loan.
Okay. So it's already established businesses, right? Like what revenue are they doing normally?
Yeah. So anywhere, just to give you an idea. So like so we're industry agnostic, stage agnostic. Like I said, the average of a maturity is about 8 years. Just to give you an idea, again, it goes from anywhere, I think 2 years, 3 years is the minimum, pretty much, that we've done, and up to 20 years. But 8 years is like the average. and they do typically anywhere between $3 and $30 million of revenues. It's a big I mean, it's a big fork, but I would say about 70% of our loan is companies that are doing anywhere between 5 and 15 millions. Dollar top line revenues per year.
Any specific niche, like BPO or marketing, or no niche?
No.
How much employees typically?
Oh, that depends, right? Because some of them are trading with very limited payroll. Some of them, there is no rules here on number of employees.
Okay, interesting. And
but
what do they use?
We want to be a little bit in between because we know that the uni person, right, like 1% type of company, they get access to some kind of, they either take a loan under their own name or they're regulated by different institutions. Like in South Africa, for example, there is a much stronger protection from a consumer standpoint than from a B2B standpoint, right? So there is a lot more regulations if you're dealing with a 1% company than if you're dealing with the real SMEs that are more than one. So for all these reasons, we believe that positioning ourselves into like the middle segments is the most interesting.
And what do they use the loan for? Do they mostly invest it in marketing?
Anything. Expansion is about like 30%. Working capital is about 50%. Growth, could be anything. If you look at F&B represents 15% of our business. It's mostly to build sometimes to build like a dark kitchen, type of things, or so you can go expansion and working capital.
Right. And what percentage go to you because they're desperate vs just like, oh, let's have more cash and safety in the bank, let's have a cushion?
So I'm always worried about the desperate. Like I don't want you see what I mean? Like it's because it's not like, again, we're in a market where they don't have, or their situation right now is desperate. Like you see what I mean? It's like, think about a market where you go to banks and you receive no's all the time, right? So my previous company were doing about $250 million top line, and even with that, I couldn't get any loan. I couldn't even get a credit card because we were just. Say what? No, previous Fetchr.
Okay.
In the UAE, right? And the only reason is because I did not tick all the boxes, right? And some of the boxes was like 5 years. One of the boxes was like 5 years of audited financial statements, and I'm like, I don't have that because I'm a 4-year-old company, right? And it's like, okay, so we can't.
Being penalized because you grow too fast, basically.
Yeah. So see, like there is some elements of like complete. I wouldn't say stupidity, but rigidity, for lack of better words. It's just like, it does not make sense. Lack of common sense, let's put it that way. So I think for us, like we're building, like we're giving a solution finally to people that were dying, to companies that were dying to recruit one or more employees, that were dying to get a second restaurant. If you do it on your own, on your own assets, we know how much time it takes. We're talking about years for you to be able to accumulate all that money so that you can invest that money, and it's a much bigger investment. So most of the time these companies don't do it, which is a problem, right? Which is exactly the problem that I was mentioning. Like we understand that job creation is mainly done by SMEs, but they're left out. They're being left out in this part of the world, right? So providing both a way to assess them faster, but also to give them the facility itself, like is not desperate. I think we're really like helping them.
And what's that specific gray zone or the silly boxes that they needed to check? Is it mostly regulatory stuff? Is it the fact that they didn't have sufficient data, enough intelligence to know what was the company about? And how could you be potentially using AI to scrape and know that on your end?
So exactly, right? So like some of these criteria that are actually pushed by banks and therefore, cutting themselves off is two things. I think is that one, like we think that the SMEs, the way they understand about compliance and ideal customer, right, is extremely outdated and not really relevant. Outdated as in mainly based on assets. Right, and you can see that right now. You go to Africa, you go to a bank. The first question they're going to ask is, "How much assets do you have?" I'm not talking about every bank, but you see what I mean. It's something that is very common. which is a problem in and of itself, especially in the digital economy. Like a lawyer will never get any kind of loan since his only assets is a laptop, and even if he has a contributing margin of like 60 or 70%, right? So there is something just fundamentally wrong on what kind of metrics is being used for them to assess whether a company is fit for a loan. So that's one. And then two, there is also regulations, right? I think that especially these economies, there is, if you look at the UAE and Saudi, for example, they've been on the strategy to build global champions, right? And we all know like the Dubai brand right now because of Emirates, tons of companies, Dubai Ports, Dubai Aluminium, that is like the third largest producer of aluminium in the world. It's all like Dubai Co, right? So the Dubai brand worked really well. Why? Is because all these companies, they sucked so much working capital out of the economy. And I'm not saying it was a bad strategy. Probably it was a good one. You see how these countries have developed. But the reality is that the SMEs is completely starved of any kind of facility, right? And now that we're talking, they're like not realizing, because that would mean that they didn't think it through, but when that you can really see that they're starved of working capital and that therefore the growth of jobs is stalling, now they are, governments in these regions are really trying to do whatever it takes to be able to unlock that. So I think we have a massive tailwind, right? Basically, a lot of government incentive. We know we're ticking a lot of boxes of this for these programs, and yeah, I think having a solution because our solution like managed to use AI, we can do like up to 100 decisions per minute, just to give you an idea, which banks obviously cannot do because they're still working with the old ways. Yeah, obviously it's a leapfrog.
And these governments, for example, so you do collaborate with them. Have you thought also about like getting money from the sovereign funds, for example?
Yeah. So the SWF, they're more like for the later stage, because like if you look at PIF or Mubadala, I mean, basically like the minimum ticket size is probably like closer to 100 million. Mubadala writes smaller checks, but it's a bit difficult. PIF definitely doesn't write anything. Even 100 million is really on the low side. So they're all interesting in this kind of initiatives, but we also cannot absorb 100 million equity. For anybody who's done any kind of startups, like you need to be pretty late stage to be able to absorb $100 million check. So yes, we believe they're going to be more partners for the long run. Like a bit later in the future, but there is a lot of things that we work hand in hand. For example, like Dubai as a Dubai SME. So we're trying to work with them to see like how, because they have like a couple of like pillars that they want to really promote, like agriculture, and a couple of others. Anyway, so solar energy. And so, yeah, we work with them to be able to deploy in these sectors first.
Right. And these old banks, are you thinking of collaborating with them? And what would happen to them in a future in which there's a bunch of agile fintechs like you? Would they adapt to that? Would they merge with them, or would they just go out?
But look, yeah, it's always I think there is a lot of value to be created by having both of us working together, right? Because I think they come with obviously a huge brands recognitions, right, from the markets. That's one. Two, they come with huge balance sheets, right? Which two things that SMEs, startup and fintechs are lacking. And then we come with innovations, being able to look AI first type of technologies that obviously they cannot match because of, just the, not really being public or whatever, but just being large organizations. It's a lot more difficult to innovate, right? Like there's the 3M stories. I mean, there's tons of stories to see like how the bigger you are, the more difficult it is for you to innovate, and entrepreneurship becomes like much tougher. So it's not even a judgment of what it is here compared to what it is in the world. It's just a sheer judgment of the size of these businesses. So I think there is a lot of value to be created. It's actually, we're working with some of the banks actually to so that we help them underwrite, and then we co-invest together. We take the first tranche loss, and then they put like 80% of the money, type of things. There is definitely a lot of ways for us to work together. And yeah, we're discussing now with 5-6 large banks in the region, outside the region, to help them.
Interesting. And South Africa, tell me why you chose that specific market.
It's very interesting, South Africa. Like it's a market where the tech ecosystem, there's typically three things that we look at to, when entering a market. One is the tech readiness. We don't want to reinvent the wheel, and you need to have the basic building blocks of the ecosystems for you to be able to get in, right? So that's one. Two, we're looking at the fundamentals, which means competition, and basically like, is there a lot, one or two fintechs, lending fintechs that are already in the markets? And then three, we're looking at bandwidth from the from a product perspective, but also from a top management perspective. South Africa, we were quite surprised by how developed the ecosystem is. On some aspects, the ecosystem in South Africa is more mature than the one in the UAE. Definitely is more mature than some of the pillars in Saudi. So we found from a tech readiness that all the building blocks, most of the building blocks were there. Competition is a bit there, which you can see that it's a bit different than the GCC. But then obviously the unit economics are even better, right? So if you manage to build a business from a CAC over LTV perspective that it makes sense, the unit economics are even far better.
Sorry, drinking orange juice here. That my lovely wife brought me. Last question, like what's next for you this year? I mean, you've grown to 4x size. How do you also like manage the risk here? The 1%, like you said, was quite exceptional. How do you have a system? Do you have an AI to keep that like under 1%? Because that's like your Achilles if that gets over 1% or 2 or 3%. So how do you keep it that low?
So, I mean, for those who have done a lending business, like they understand that less than 1% is extremely rare. If you look at the typical lending NPL, I mean, anywhere between 4 and 8%, you start seeing that at 8% start falling, things start falling. It becomes a lot more difficult to have to make all the numbers, the unit economics work, CAC over LTV work. It becomes a lot tougher. So like below 1% is exceptional. I do not know whether we're going to be able to keep it below 1%, but touching wood and hoping it's going to work. The reason why we are below 1% is a combination of a few things. One is obviously the underwriting, our ability to underwrite and crunch the numbers and making sure that we're not taking too many risks. And then two, it's also collection, right? Because obviously it's easy to get a loan out. It's a lot tougher to get the loan back, right? So to get the money back. So being in a place where the either collection, direct debits, all this stuff is automated is super important. So whether you have to build it yourself or rely on a third party is critical. Where, for example, going into markets where any kind of direct debit or any kind of collection at source is impossible, we're not interested in these markets, right? Because it means that our collection is not going to be automated, which means that our NPL is going to go through the roof and it's probably what's going to kill the company. So it seems trivial, but some of these elements are super critical in our analysis. So we hope we're going to stay as low as possible from an NPL perspective, but also we're aware that, staying below 1%, it probably means that, we're a bit wrong many times by saying no to loans that we should be able to say yes. But we're so constrained now anyway that it's obviously the right strategy. But in the future, we're probably going to need to take slightly more risk and increase the NPL a bit.
Love it. Idriss, well, where can people find out more about you and your company?
But I mean, look, I've got a few things online on my, I guess probably my LinkedIn. I'm not so much on social media and so on, but on LinkedIn they can find me, and happy to connect there and having sessions.
So it's Idriss and Charles.